The next decision that we're going to look at in Chapter 13 is a make or buy decision. So we're trying to decide whether we should make every single component of whatever we're manufacturing, or if we want to buy them from an external supplier. The advantages to is that if we do them internally, is that we have a smoother flow of parts and materials, we have control over all of the quality, we realize all of the profits. The disadvantages, however, is that we might fail to take advantage of suppliers who can create economies of scale by pooling demand from numerous companies. So we might be able to save money by doing mass orders, but we want to make sure that we retain control over activities that are essential to maintaining our competitive position. We also want to make sure that if we buy or outsource any of our products, that we're still guaranteeing some kind of a control standard. So we're going to look at example now. We have a company that manufactures a part called 4A. We use this product in manufacturing, and the product cost of this particular part is $30, composed of direct materials, direct labor, variable overhead, and fixed overhead, general fixed overhead, and depreciation, and the supervisor's salary. The special equipment used to manufacture that part has no resale value, and the total amount of general factory overhead is allocated on the basis of direct labor hours and would be unaffected by this decision to make or buy. The $30 unit product cost is based on 20,000 parts produced each year. However, an outside supplier has offered to provide us this part at a cost of $25 per part. So should we stop making part 4A and buy it from an outside supplier? So we're going to look at the difference between those decisions. So if we purchase it from the outside supplier, we get 20,000 parts for $25 a part. It's a total cost of $500,000. However, if we make the part, we're going to remove the allocated general factory overhead and the depreciation because the cost incurred to buy the equipment and the depreciation is considered a sunk cost. And the allocated general factory overhead is allocated costs common to all items produced in the factory. That would not be changed. Since we can't change it, it is not a relevant part of our decision. So the avoidable costs associated with making part 4A are direct materials, direct labor, variable overhead, and the supervisor's salary. Those are the things that we could save by buying it from an outside supplier. When we look at the incremental decision then, we see that it's actually cheaper for us to continue making that part than it is for us to buy that part from an outside supplier. However, we need to think about the opportunity cost. So opportunity costs are not actually cash outlays. They don't get recorded in any of our accounting structure, but it is the benefit that is foregone as a result of pursuing some course of action. In this case, if we decide to continue making part 4A, we can't use that space for anything else. So we have to look at, does that space have an alternate use, and would that alternate use provide a better benefit than the savings from continuing to make part A? Another special decision that we make is special orders, whether or not to take on a special order. So a special order is a one-time thing that's not considered part of our normal business. When we're looking at a special order, only the incremental costs and benefits are relevant. Since the existing fixed manufacturing overhead costs are not affected by the order, they are not relevant. So we're going to be looking at additional revenues and variable costs because we can't change the fixed manufacturing overhead cost, or we can't eliminate them. So we don't consider them as part of a special order decision. So we have a company that makes a single product whose normal selling price is $20 per unit. We have been offered a special order from a distributor. They want to purchase 3,000 units for $10 per unit. This is a one-time order that would not affect the company's regular business. Annual capacity is 10,000 units, but we're currently producing and selling only 50,000 units. So we're not operating at full capacity. That is a consideration in special orders. Do we have the capacity to take on the order or not? So we're going to look at, should we accept the order? So before considering the special offer, we sell 5,000 items. So we can see what the costs are for our normal operations. If we accept the special order for 3,000 at $10, the incremental revenue exceeds the incremental cost. So we'll have an additional operating income of $6,000. This suggests that we should accept the order. This is, of course, assuming that the fixed costs are unavoidable and that variable marketing costs must be incurred in the special order. If the variable marketing costs weren't also incurred, we would actually have a better financial advantage of accepting the order. So if we look back at the original income statement, we can see that our total variable costs are $40,000 for 5,000. So if we take 40,000 divided by 5,000, that is where we get the $8 variable cost. Occasionally, under special orders, we don't have to pay whatever selling or marketing expenses as part of those. So we would remove that from the variable costs. Now we're going to talk about capacity. So sometimes we have to make trade-offs when we don't have enough capacity to produce all of our products at the sales volume demanded by our customers. When we're faced with these decisions, we must trade off or sacrifice production of some products in favor of others in an effort to maximize profits. So then, if we only have so many hours in a day, but our products are really high in demand, we're going to focus on the products that make the most money or maximize our profits. Basically, the ones that give us the best contribution margin per whatever the limited resource is. So we have a limited resource of some type that restricts our capacity. It's called a constraint. We can have a labor constraint, a machine hour constraint. This is also called a bottleneck. This means that we have a part in our production process that can only do so many things per day or per hour. So it becomes a constraint to the process. We can only make as many things as what this constraint is available to make. Our fixed costs are unaffected in these situations usually. So it's the product that maximizes the total contribution margin is the one that we should select. We don't necessarily want to promote those products that have the highest unit contribution margins. Rather, we want to look at the contribution margin that's maximized by promoting the orders that provide the highest contribution margin in relation to the constraining resource. That was a lot of words for this concept. Let's look at an example. So we have two products. We have information about those products. So we have a machine processing time that's limited on this machine A1. So we have the selling price per unit, the variable expenses per unit, contribution margin per unit, and the current demand, and our contribution margin ratio. We need 1 minute for product 1 and 0.5 minutes for product 2. Machine A1 is a constrained resource. It's being used at 100% of its capacity. We have excess capacity on all other machines, but machine A1 only has capacity of 2,400 minutes per week. Now you might say, why don't we just buy a second machine 1 so we can create all of the products without that bottleneck resource? But right now we're looking at what if we only have one machine and we don't have the space or the money to buy a second one right now. So which one should we focus our efforts on? What we want to know is what is the contribution margin per minute? So because that's what we're constrained by in this capacity. So the contribution margin per unit of the constrained resource. The unit of the machine A1 is by minutes. We have 2,400 minutes. We're going to emphasize product 2 because it generates a contribution margin of $30 per minute versus product 1's $24 per minute. So you take the contribution margin per unit divided by the time required to produce 1 unit, and you get the contribution margin per minute. When we look at then the utilization of a constrained resource, we can make both products, but we want to make sure that we make our full demand of product 2 because it has the highest contribution margin. We then use the leftover time to make as many of product 1 as we can. So we have a lot of demand for both products, but we want to focus our efforts on the product that makes us the most money. So we make the full demand for product 2 and use whatever is left of the resource to make product 1. So we have that we make 2,200 units of product 2 and 1,300 units of product 1. So our total contribution margin is $64,200. Increasing the capacity of the constrained resource should lead to increased production and sales. So how much would we be willing to pay for an additional minute of machine A1 time? The additional machine time would be used to make more units of product 1, which has a contribution margin per minute of $24. That means that we would be willing to pay up to $24 a minute to increase the capacity on this. If we were looking at buying a second machine, this would be part of our analysis on whether that machine was a worthwhile purchase or not. Sometimes we can increase the capacity of a bottleneck by relaxing or elevating the constraint in numerous ways. One of the ways is we can work overtime on the bottleneck. If we only have one shift with the rest of the manufacturing, we could do 2 shifts on the bottleneck. One is to subcontract some of the processing that is done at the bottleneck, which means that we would pay someone else or outsource what machine A1 does to a contractor who can do the same thing. 3 is buying another machine. 4, shifting workers from non-bottleneck processes to the bottleneck. That really only works if it's a direct labor constraint. If it's a machine hour constraint, putting extra laborers on it isn't going to alleviate that constraint. We can also look at business process improvement efforts of the bottleneck and reduce defective units processed through the bottleneck. Another thing that we can do is product engineering. So we could go back and look at product 1 and 2 and how they use machine A1, and we could ask our design engineers to look at ways to improve the product, one or both of the products, so that it doesn't need the resources from machine A1. So how could we redesign product 1 so it doesn't use this machine anymore? That's another way to alleviate a constraint.